aisle, there is a seat available for you, sir. And Ms. Rice from Toledo, there is a seat available to you too, as there always is at our table, so thank you. The Committee on Banking, Housing, and Urban Affairs will come to order. Today's hearing is a hybrid format. Our witnesses are in person. Member of all five of you, thank you. Our members have the option to appear in person or virtually. When work has dignity, every American can fully participate in and receive the benefits of our dynamic economy. Financial services and products have played a critical role in helping many families build wealth and plan for the future, whether that means saving for college or retirement or their first home. Many Americans have been able to do just that. However, not every community has gotten its share of that prosperity. It's especially true for Black and brown Americans who are too often shut out of the financial system because of discrimination. Let that sink in. In 2022, in the United States of America, you can be turned away at a bank because of the color of your skin. The wealth and income disparities between white and minority households are a consequence of the unequal access and treatment that minorities have faced. From accepting slaves as collateral for loans, to Jim Crow, to redlining, to the subprime mortgage crisis, predatory practices, to the current crypto crisis, Black and brown Americans have never had access to or fair treatment in financial services. Today's hearing is an opportunity for this committee to reckon with not only the legacy of discrimination, but the current reality of the pervasive and pernicious discrimination in financial services. The 2021 FDIC household survey found that 11% of Black households, 9% of Hispanic households were unbanked, compared to 2% of white households. For Black Americans with checking accounts, it's not always better. We know that some banks close checking accounts at significantly higher rates in communities with more Black residents. The fact is that many brown and Black Americans don't have access to, nor do they trust, our financial system. Think about Dr. Malika Mitchell Stewart, a doctor, physician from Texas. She attempted to open an account and deposit her signing bonus check. The bank tellers raised questions about the check's authenticity, and as a doctor, they all turned her away. Arrived in her fear, Wells Fargo branch, and she went to a wealthy security deposit check and her identification. Ms. Middleton offered the police. Black Panther, which I recommend. While trying to withdraw money, the bank teller his bank card, his pen, his ID. The teller assumed Mr. Kugler was trying to rob the bank. Mr. Kugler's case shows that even wealth and fame can't overcome or stop discrimination. Black and brown customers are viewed with suspicion sometimes for just entering a bank and are questioned over the most basic transactions. And because access to basic financial services is how families build wealth, discrimination in banking worsens the racial wealth gap. Many brown and Black consumers have no place to securely hold their funds. When consumers are pushed out of financial services, they're forced to rely on check cashers. They have far fewer opportunities to build relationships with financial institutions, relationships that matter when trying to buy a home or start a small business. The pandemic revealed the detrimental consequences for minority consumers who've been unable to build that relationship with financial institutions. Not only were minority small business owners left out of important programs like the Paycheck Protection Program, but small business owners without banking relationships who were able to obtain federal aid were sometimes barred from accessing those important funds. Congress has worked to address this fundamental unfairness with legislation. Civil rights statutes like the Equal Credit Opportunity Act, the Community Reinvestment Act, seek to ensure equal access to credit and to combat discriminatory practices such as redlining. The Civil Rights Act of 1964 outlawed discrimination in certain places of public accommodation, hotels and restaurants. We know that, but it doesn't cover banks. Federal courts have held that the law enumerates specific types of businesses. Those that are not on the list, such as financial institutions, simply aren't covered. We must do more to ensure that all Americans have equal access and equal treatment in financial services and products. The lack of clear protections, the loophole within the Civil Rights Act, make it difficult to end discrimination, make it hard for victims of racial discrimination to hold these banks accountable. Minority consumers often also have access to less of their own funds. One report found Black and Latino customers are required to maintain a minimum balance of $821 and $879 respectively, compared to a minimum balance of $648 for white consumers. Black and Latino consumers, unlike white consumers, simply don't have access in too many cases to their own money. Banks say they're committed to eradicating the legacy of racism in our financial institutions. Many bank CEOs have sat at the table the five of you are sitting at, promising that. Yet a week after the CEOs of our largest banks sat before this committee and promised to fight against discrimination, the American Bankers Association sued the Consumer Financial Protection Bureau for updating its examination manual to scrutinize unfair discrimination. Think about that. We know that Wall Street may always attack the CFPB, but their opposition has reached, shall we say, frenzied levels with Rohit Chopra at the helm. Under Director Chopra, the CFPB is using all of its authorities to fight discrimination. They've repeatedly gone after financial institutions for their treatment of Black customers. Earlier this year, CFPB announced it will examine whether discrimination violates the Dodd-Frank prohibition against unfair, deceptive, and abusive acts and practices. In 2021, CFPB required a bank to pay $5 million to address redlining that harmed Black consumers. Since its creation, the CFPB has gotten $637 million from discriminatory institutions might be more accurate, tens of millions of which have gone directly to minority consumers who experience that discrimination. It's no surprise when an effective agency like CFPB actually works on behalf of its consumers. No surprise Wall Street does everything it can to stop it. We don't see banks holding true to their commitment to fight discrimination, simply put. To ensure that all Americans have dignity in work, we must work to end discrimination in banking. Senator Tim.
Thank you, Mr. Chairman, and thank you to our witnesses. Equal treatment under the law is a fundamental American value. Discrimination and racism are wrong and have no place in our society. Unfortunately, they are a sad part of our nation's history. And even though we've made great strides in dramatically reducing discrimination in our society, that does not mean instances of racial discrimination never take place today. Sometimes they do. And when they do occur, the government should enforce the anti-discrimination laws, including in financial services. However, in recent years, some Democrats have sought to advance a liberal legal theory called disparate impact. Disparate impact is not the same as discrimination, far from it. Disparate impact theory punishes people if they make business decisions that produce statistical differences in outcomes between demographic groups, even if there's no discriminatory motive. There can easily be differences in outcomes when there's been absolutely no discrimination. Now, in theory, defendants can prevail in disparate impact cases if they can prove at trial that there was a business justification for the policy that created the disparate outcomes. But in practice, these cases entail significant costs and reputational risks that can force even innocent defendants to settle. In this way, disparate impact is a gift from liberal Democrats to trial lawyers. It's also a boon to regulators inclined to abuse their authority, including the CFPB. For example, the Obama CFPB claimed to have discovered discrimination based on disparate impact by auto lenders who didn't even know the race of the borrowers they were accused of discriminating against. Now, to underscore the absurdity of this, not only did the lenders not know the race of the borrowers, the CFPB didn't know the race of the borrowers that it claimed were being discriminated against based on race. But that didn't stop the CFPB from discovering racial discrimination. The CFPB's actions weren't authorized by statute, but to make matters worse, they were based on flawed methodology, badly flawed. The CFPB guessed race based on last names and zip codes, even though they knew this method was flawed. For instance, this methodology predicts that there's an 89% chance that Chairman Brown is Black and a 64% chance that Senator Tim Scott is white. Moreover, CFPB documents showed the agency knew that credit scores and other business factors accounted for much of the statistical disparities, and there was a significant risk the CFPB would lose in litigation. Nonetheless, the CFPB brought enforcement actions that they knew They might very well fail in court because they determined that defendants have, and I quote, a powerful incentive to settle, end quote, as we discovered in CFPB's internal documents. And so they could drive these defendants to settle cases where they might have been able to win. This is an outrageous abuse of government power. To pursue litigation because you know the costs, economic and otherwise, would drive an innocent person to settle. In 2018, Congress overturned the CFPB's disparate impact guidance for auto lending. Nevertheless, the Biden CFPB has expanded its use of disparate impact theory, effectively extending the very policy Congress overturned. The CFPB has claimed the authority to supervise for disparate impact in all consumer financial services and products based on an unprecedented reading of the Dodd-Frank's grant of authority to prevent unfair, deceptive, or abusive acts or practices known as UDAP. But Congress did not authorize disparate impact under UDAP. In the 12 years since Dodd-Frank was enacted, the CFPB never previously claimed that it had that authority. Congress took the UDAP language from the FTC Act. For nearly a century, the FTC never interpreted that language to include discrimination or disparate impact until after the CFPB's novel reinterpretation. Well, this is exactly the kind of abuse of power that the Supreme Court recently ruled against in West Virginia versus EPA, when the EPA, in the words of the Supreme Court, and I quote, claimed to discover in a long extant statute an unheralded power representing a transformative expansion in its regulatory authority, end quote. They could have been describing the CFPB. To make matters worse, the CFPB implemented this controversial change in law by fiat without even going through a rulemaking. This overreach was possible because the CFPB is structured to be unaccountable to Congress. It can simply take funds from the Fed, which also is not subject to appropriation, thereby doubly insulating the CFPB from congressional appropriation and control. This is why the Fifth Circuit recently found the CFPB unconstitutional, holding that its funding violates the Appropriations Clause of the Constitution. The court noted, and I quote, the Bureau's perpetual insulation from Congress's appropriations power renders the Bureau no longer dependent and, as a result, no longer accountable to Congress and ultimately to the people, end quote. It's no surprise that this unaccountable agency disregards the law, and it's no surprise the CFPB is already being sued for its disparate impact overreach. A harmful effect of the CFPB's unauthorized expansion of disparate impact is that it creates tremendous uncertainty. Any action taken by financial institutions may subject them to disparate impact liability, even if they have no way of knowing whether a disparate impact will occur. They'll likely have to pass on the cost of liability to consumers or just avoid potentially frivolous litigation by not offering the services and products in the first place. So the expected outcomes of disparate impact liability are higher costs and less access to financial services for low-income families, which disproportionately harms minorities. The Biden administration should stop abusing its authority to advance this misguided liberal legal theory. Thank you, Mr. Chairman.
Thank you, Ranking Member Toomey. I'll introduce today's witnesses. Ms. Lisa Rice from Toledo, Ohio, is the president and CEO of the National Fair Housing Alliance, one of the nation's leading experts on fair housing and lending policies. Welcome, Ms. Rice. Mark Morial is the president and CEO of the National Urban League. He previously served as mayor of his hometown of New Orleans and is the president of was president of the U.S. Conference of Mayors. President Morial, welcome. Byron Donalds represents Florida's 19th Congressional District before holding office. Representative Donalds worked in the banking, finance, and insurance industries. Congressman Donalds, welcome. Mr. Devin Westhill is the president and general counsel at the Center for Equal Opportunity. He served as the top civil rights official at the United States Department of Agriculture. Mr. Westhill, welcome. Janai Nelson is the president and director consul at the NAACP Legal Defense and Education Fund prior to joining LDF. She was associate dean for faculty scholarship and associate director of the Ronald Brown Center for Civil Rights and Economic Development at St. John's University School of Law. Ms. Nelson, welcome. Ms. Rice, please begin your testimony.
Thank you. Chairman Brown, Ranking Member Toomey, and other distinguished members of the Senate Banking Committee, I am so appreciative of you for inviting me to testify today. The National Fair Housing Alliance is the nation's only national civil rights organization solely dedicated to eliminating all forms of housing and lending discrimination and creating well-resourced, healthy, vibrant, resilient communities. I can empathize with people like Ryan Coogler, who, although being one of the world's most noted and award-winning film directors, was falsely accused of being a bank robber and detained by police when trying to withdraw money from his own bank account. I, too, personally, have experienced differential and humiliating discriminatory treatment when trying to access services from financial institutions. No one should have to experience these types of indignities. Discrimination in financial services is built on our nation's enduring legacy of discriminatory policies and practices. Thousands, literally thousands, of race-based laws like the Indian Removal Act, Jim Crow laws, Black codes, the Homeowners Loan Corporation Act, the National Housing Act, and many other statutes and policies put in place over the last 400 years created inequitable systems like residential segregation. In fact, we're more segregated today than we were 100 years ago because of these discriminatory policies. We have a biased appraisal assistant, unfair zoning policies, the dual credit market, and biased algorithms that are still in place today, impacting millions of people. In addition, too many people experience unfair treatment and denial of critical financial services and products. The ongoing failure of financial services providers to fairly serve all consumers and communities harms individuals and neighborhoods, stifles innovation, restricts economic progress, generates wealth loss, and makes the U.S. less globally competitive. The cost of discrimination is incalculable. According to research from the Brookings Institution, homeowners in predominantly Black neighborhoods have lost cumulatively $162 billion in wealth due to appraisal bias. Another study found that eliminating bias against communities of color would have resulted in an additional 770,000 Black homeowners and an additional $218 billion in sales and expenditures. But due to biased policies and practices, consumers, our society, and the economy lost out on these benefits. Citigroup estimates that eliminating racial inequities for Black consumers alone would add $5 trillion to the U.S. GDP over a 5-year period. The Fair Access to Financial Services Act fills a critical gap in the fabric of our nation's civil rights and consumer protections, and is vital to ensuring people can fully participate in our modern-day economy and that our society can thrive. It covers discriminatory practices not precluded by the Civil Rights Act of 1866, the Fair Housing Act, the Community Reinvestment Act, and the Equal Credit Opportunity Act. A fair, open, and equitable marketplace promotes economic health and wealth for people, communities, and the greater society, solidifying our position as a global leader and making our nation stronger. The nation's history of discrimination, segregation, and financial exclusion reverberate to this day, having massive consequences in the lives of everyday Americans who simply want to use the services that are necessary to fully participate in our economy. Congress has done well to pass hard-earned legislation aimed at preventing this history from being repeated, but more can be done to close loopholes in our civil rights enforcement infrastructure to better protect people of color and other marginalized consumers from discrimination in financial services. The Fair Access to Financial Services Act is an important step in the right direction, and we look forward to working with the committee and members of Congress on this legislation.
Thank you, Ms. Rice. Mr. Morrell, welcome.
Thank you very much. Chairman Brown, Ranking Member Toomey, and members of the committee, I want to thank you for the opportunity to testify before you this morning. I lead the National Urban League. We serve over 300 communities through a network of 92 affiliates across the nation. Since 1910, we've been in the forefront of the effort to build generational wealth within the Black community and other underserved populations. Throughout our work, we have seen the dire consequences of an American financial system that has systemically cut off and shut out individuals, families, businesses, and communities of color from access to capital. Nearly 150 years after the closing of the Freedmen's Bank, in the wake of a global pandemic that revealed the true extent of the economic insecurity of communities of color, given all that we know about the historical systemic bigotry of banks and governments against communities of color, even after the end of slavery and Jim Crow, and in the shadow of an outrageous coordinated attack by some against the newly systemic efforts to address the harms of bigotry, I can think of no more important hearing than this one today. When people of color suffer racist engagement in the financial marketplace, it causes substantial monetary and non-monetary harm to both them and to this nation. Depending on how racist behavior occurs, be it systemic, digital, in person, community members are often unaware or unable to prove that they receive disparate treatment or a discriminatory outcome. In 2021, 4.5% of U.S. households, that's 5.9 million people, were unbanked or underbanked or in banking deserts, meaning that no one in the household had a checking or savings account at a bank or credit union. The likelihood of being unbanked is even higher for Black and Hispanic families. 8% of Black households, 8.4% of Hispanic households are unbanked. Only 1.7% of white households are unbanked. Less than a decade ago, during the Great Recession, comparably sized banks closed at higher rates in markets serving communities of color between 2009 and 2014, with some Black and Hispanic communities losing half of their bank branches. This uneven distribution of bank branch locations exacts a cost on residents of communities of color in the form of greater traveling distance and time to the nearest banking facility. These practices create banking deserts in which predatory payday lenders, check cashers, and other non-bank services thrive, thereby implicating banks in facilitating a market dynamic where the financial services environments in communities of color are dramatically different in terms of quality, experience, and expense from those in white non-minority neighborhoods. In addition to the reluctance to operate in communities of color, another source of racial discrimination may be bank employees' discretionary power and practices in charging costs and fees. Bank employees wield discretionary power in racially executing bank policies. They determine how much a customer pays in costs, and customers may face varying fees depending on whom they talk to at a bank. These concerns regarding discrimination and bias have led to lawsuits rightfully brought by the U.S. Department of Justice Civil Rights Division, which illuminated the widespread discriminatory practice, including loan officers who referred to some prime loans in minority communities as ghetto loans, as minority people as mud people. The consequences of these acts are reflected in the data in the National Urban League State of Black America 2022 Equality Index. Blacks are much likely to be approved for mortgages than white Americans. The disparity rate is 41%. The homeownership rate for Black Americans, after plunging down to 40% in the aftermath of the Great Recession, has climbed back to 43%, but compared to whites at 74.4%, this is a wide disparity. I want to just outline that the National Urban League is in the forefront of greenlining initiatives by investing directly in the communities we serve. And our new Empowerment Center, a $250 million mixed-use real estate project in Harlem, which combines financing from every single tool, new markets tax credits, low-income tax credits, equity, and debt, will provide thousands of jobs for Harlem and provide a new headquarters for the National Urban League, high-quality retail stores, and a new civil rights museum. Weaken Green Line versus Red Line. Today, I'm proud to say that the bill that you all have proposed would fill important gaps, Senator Brown, in this ecosystem of protections necessary to protect people from systemic discrimination in the marketplace. And I want to close with this point, which is an important point. Every study, whether by Brookings or McKinsey, shows that if we close the racial wealth gap in this nation by eliminating discrimination in access to capital, in wages, and in home ownership, the impact on the American economy will be 2 to 3 trillion in GDP. Let us understand that systemic discrimination affects not only Black and brown communities, but affects the nation at large. This is about the America of the 21st century. So I thank you, and I look forward to the question and answer period.
Thank you, Mr. Morrell. Mr. O'Donnell's welcome.
Chairman Brown, Ranking Member Toomey, thank you for inviting me to testify on this important topic of racial discrimination in financial services. Having had a career in financial services myself, I can speak firsthand to the issues and the complexities of our capital markets here in the United States. As a Black man, I understand the burden of discrimination and racism, and I'm thankful that discrimination is illegal in our country. Is our financial system perfect? No. Is it far superior and far more inclusive in comparison to the rest of the world? Absolutely. While I could point to the loss of banks and minority communities post-Dodd-Frank, or highlight the frivolous regulatory red tape that negatively impacts economic growth in these communities, I would like to start off with the most glaring, obvious fact. Our markets can't flourish and best serve consumers when they are saddled with regulatory uncertainty. Government agencies shouldn't expand their own authorities in ways that subvert the stated purpose, avoid congressional review, and break the law. It's harmful, it's illegal, and it's unconstitutional. Case in point, the CFPB's lawless steps to address gaps and unfairness, quote unquote, in the financial services industry. The CFPB's use of the Unfair and Deceptive Acts or Practices Authority contradicts the Dodd-Frank Act's treatment of unfairness and discrimination, which under the law are two separate and distinct concepts. The heavy hand of government is weighing down American consumers through infinite rulemaking and guidance. This way of governing isn't in good faith, and it isn't a sustainable way of conducting business for the people. Discrimination and racism should absolutely be taken seriously, and that's why there are laws in place, such as the Equal Credit Opportunity Act and the Civil Rights Act. Disparate impact can't be used as a justification for government overreach. I think everyone in this room today would agree that there is progress to be made in growing economic opportunity for all Americans. But that's impossible with a financial activist mindset infused with bad policy prescriptions that don't solve the problem. I've worked in financial institutions, and there are two colors financial institutions are concerned with: green and red. There are two categories considered: credit-worthy or risk-prone. And I would add, my start in financial services was at a credit as a credit officer. I underwrote loans, so I know this firsthand. There's no subliminal mission to deny access to products based off of race, sexuality, religion, or any other identification of the sort. Banks prioritize handling business, and if any individual meets necessary standards to conduct business with them, that's what banks will do. Taking credit risks into account is responsible banking. It isn't racism or discrimination. We should prioritize ways to help struggling individuals prosper. How can we help create better outcomes for consumers? Well, it's about 4 basic ways. 1, collaboration between government and private sector is key to address nuanced issues. Agencies should adhere to the rulemaking process. Engaging equally with all stakeholders creates a full picture that prevents undue harm on consumers or unintentional consequences. And I would add, our economic history is replete with unintentional consequences that come from Capitol Hill. Number 2, relax de novo banking requirements. Since Dodd-Frank, almost half of the community banks in the United States have failed, and that has had a critical impact on minorities. We see the impact this has had on minorities at the beginning of the pandemic with the PPP program. It wasn't the case of banks not wanting to engage with minorities. It was simply that there was not a pre-existing relationship which inhibited small minority-owned businesses from getting to the first round of PPP. Long story short, if there aren't banks in the area, how are the businesses in that area be able to get to the consumers? If there's no existing relationship, how are you going to be able to make that thing work, especially when PPP was dropped on everybody in the United States at a moment's notice? Number 3, actions taken by agencies should be based on unbiased data, not anecdotal evidence or assumptions. Agencies should also assess actions taken by industry leaders to ensure there isn't duplication between regulators' actions and what banks are already doing to address the needs of underserved communities. Number 4, financial literacy should be prioritized. Discrimination and disparate impacts aren't the same, and we've got to understand that equal opportunity doesn't necessarily mean equal outcomes. If individuals lack creditworthiness that impacts other outcomes relating to financial services, we should be looking at ways to address that, like alternative data, in order to shore up their creditworthiness. The reality is, not every American will reach a place of financial wealth, but most Americans can reach a place of financial health. In closing, racial discrimination in financial services is illegal. It was before this hearing. It will be after this hearing. Expanding the government is not needed or justified.
Thank you, Mr. Westhill. Welcome.
Thank you, Chair Brown. Thank you, Ranking Member Toomey, and to the committee members as well. I'm very happy to be here. I think this is an important topic. I'm Devin Westhill. I run an organization called the Center for Equal Opportunity. Our mission's right there in the name. We advance colorblind equal opportunity and non-discrimination in America. That mission is of both professional and personal importance to me. I've written, spoken widely on the topic, including before the U.S. Congress earlier this year at a hearing on discrimination and civil rights of Asian Americans. More fundamentally, I'm a black man from the South with a Vietnamese wife with whom I share, like so many other people in this country, 2 beautifully multiracial babies. My primary concern here today is how the mission to promote non-discrimination is carried out. In particular, I'm worried about the decision of the Consumer Financial Protection Bureau, the CFPB, to utilize a disparate impact analysis to identify unlawful discrimination in financial services. So let me expand a little bit on what Ranking Member Toomey mentioned about disparate impact. Disparate impact claims are distinct from disparate treatment claims because plaintiffs are not required to show any intent to discriminate under disparate impact theory. To establish a disparate impact claim, a government agency or private plaintiff must show that a practice or policy that is non-discriminatory by its terms, in its intent, and in its application disparately affects members of a protected class. I go into further detail in my written testimony. I commend it to you. But it's hardly ever the case, right, that disparate impact will, not the case that disparate impact will result from decision or policy, but instead, by how much and whether you can identify the direct cause of it. If you don't take anything else away from what I say here today, take this. Disparity is not discrimination. Disparity is not bias. Disparity is not racism. These things are distinct. And there's a problem in underestimating discrimination and bias and racism. I admit that. That is clear. But I think we also have to admit that there's a problem in overestimating it as well. And calling something discrimination or racism or bias when it's not is also problematic. It makes little sense to equate imbalances in one way or another, such as in the racial composition of loan recipients, with discrimination. Imbalances often have a multitude of contributing factors and do not always disfavor minorities. The sentiment is well summed up, as so often is the case, by economist Thomas Sowell in his book, Discrimination and Disparities. If there is not equality of outcomes among people born to the same parents and raised under the same roof, why should equality of outcomes be expected or assumed when conditions are not so nearly comparable? The CFPB's use of disparate impact may harm minorities most, in fact. And I think that's what Congressman Donalds was getting at in terms of the unintended consequences of rejiggering certain things in the CFPB examination manual. It can encourage race-based decision-making in financial services. The outcome-focused approach to disparate impact analysis disincentivizes for potential defendants or covered entities, regulated entities, the use of legitimate race-neutral policies, and instead encourages race-based decision-making. Just the opposite of what civil rights laws like the Equal Credit Opportunity Act are meant to do, for fear of liability. Put more directly, creditors will be perversely incentivized to judge consumers in part by the color of their skin, rather than, as should be the case, their financial risk based on generally accepted credit assessments in order to achieve a predetermined racial balance. That's not something we should be encouraging. Taking race into consideration and making any decision has never been a boon for minorities in America. This creates profound business uncertainty and whiplash as well that flows to consumers, which will disproportionately harm minorities. I think there's also a disregard for the plain language of the ECOA and case law. The Supreme Court has consistently held that statutes that provide a disparate impact cause of action must contain effects or, quote, results language, like the court has found in the Fair Housing Act, the Age Discrimination Employment Act, and Title VII of the Civil Rights Act of 1964. The court has refused to hold disparate impact claims cognizable under statutes that lack such language, like Title VI. The ECOA, like Title VI, contains no effects-based or consequences-oriented language. I could go on for quite some time about the increased costs in litigation or threat of litigation that businesses will face under disparate impact regimes, and how that flows to consumers and hurts most minority consumers and low-income consumers. We ought to carefully and thoughtfully work to reduce racial discrimination as much as possible in this country in so many ways, a country that in so many ways has sanctioned it, not just for preferred classes or races, but for everyone, every single individual. I'm committed to that, but I think disparate impact is a very dangerous theory that can turn on its head that mission. Thank you.
Thank you, Mr. Westhill. Ms. Nelson, welcome. Thank you for joining us.
Chair Brown and Ranking Member Toomey and members of the Senate Banking Committee, it's an honor to be here. My name is Janae Nelson, and I am the President and Director Counsel of the NAACP Legal Defense and Educational Fund, and I am grateful for this opportunity to testify about racial discrimination by financial institutions. There have already been many examples cited, and I will cite one more that speaks to the disparate treatment and discrimination that so many Black people face in this country, and that goes underreported in our society. Less than a year ago, in 2021 December, a Black man by the name of Peter Wogba went into U.S. Bank in Bloomington, Minnesota, and requested a cashier's check from his business account. The tellers refused to issue the check and told him the money was unavailable. Even after he called U.S. Bank's 1-800 number to confirm the wire funds were there, the tellers told Mr. Wogba to go to a different branch and to get the check there. They then called the police. This discrimination has severe consequences. Unfortunately, his story is not unique. This is an underreported phenomenon, and Black people and other people of color are disproportionately denied equal access to financial services that are essential to creating economic opportunity, the opportunity that some have referenced here today. By depriving communities of color equal access, these financial institutions, which are intended to serve the public, the entire public, and fuel our economy, deprive certain communities of an equal opportunity to save for the future, to invest in a business, to buy a home, and importantly, to build intergenerational wealth. According to the Brookings Institute, communities of color have fewer options when it comes to financial services than majority white neighborhoods. Banks in these neighborhoods often require higher initial deposits, minimum account balances, and as a result, the Federal Reserve found that an estimated 40% of Black Americans are either unbanked or underbanked. People of color are also denied loans at higher rates and are offered worse terms than other borrowers. In 2022, the FDIC found that Black borrowers are more likely to be denied mortgages and pay higher interest rates than white borrowers, even when controlling for other factors. And that point must be underscored because this debunks the myth that it only requires motive. When you control for other factors and racial disparities still result, that is evidence of discrimination. The Federal Reserve also found that approximately 14% of small Black business owners received all the financing they sought from banks, compared to 34% of white small business owners. Discrimination by financial institutions impose significant costs on communities of color. And we've written about this. Our Thurgood Marshall Institute produced a publication, The Black-White Racial Wealth Gap, which I commend to this committee. And I want to underscore what some of my colleagues have already said, and that is that the cost is not borne by communities of color alone. It is borne by our economy that could be thriving, that could be far more expansive if this discrimination did not occur. And when we think about the calculus between the cost of any outcome to preventing discrimination, we must also think of the lost economic gain that results from racial discrimination in financial services. As has been mentioned, this U.S. economy suffers from a loss of $1 to $1.5 trillion between 2019 and 2028 as a result of racial discrimination in financial services. And the federal courts have made it very difficult for individuals who are harmed by financial institutions to use existing civil rights statutes to address racial discrimination. And I will give 3 brief examples. The Civil Rights Act of 1964 prohibits discrimination in public accommodations for people who have a disability, but not based on race. That disparity must be fixed. ECOA prohibits racial discrimination by lending, and the Fair Housing Act does, but it doesn't address non-credit transactions. That's an omission that must be addressed. And while sections 1983 and 1982 of the Civil Rights Act of 1866 prohibit racial discrimination in contracts, the Supreme Court and other courts have narrowed the ability to use those statutes effectively. Most recently in Comcast versus National Association of African American Owned Media, where the Supreme Court imposed a reading of Section 1981 that imposes a high burden on harmed individuals and makes it harder for them to hold financial institutions accountable, imposing a but-for causation requirement. So we must do more to address racial discrimination by financial institutions. We applaud you, Chairman Brown, for introducing this legislation. This bill makes clear that financial institutions have the same obligation not to discriminate on the basis of race as any other public accommodations. We are encouraged to see legislation being proposed that would eliminate barriers to the Supreme Court created by the Comcast case, and we look forward to working with this committee to ensure full financial inclusion for communities of color. And I look forward to your questions, especially exploration of the definition of discrimination and what it entails.
Thank you, Ms. Nelson. My first question addressed to Ms. Rice, Mr. Morreale, and Ms. Nelson together. Just to be clear, in the year 2022, did financial institutions discriminate against Black and brown consumers? Ms. Rice?
Yes, in fact, we just released yesterday the Fair Housing Trends Report, which showed Senator Brown an 8.7% increase in the number of housing discrimination complaints filed. This is the largest number of complaints filed by consumers that we have ever seen. We've never seen this level of discriminatory complaints filed by consumers. And we saw an increase in not only the number, but the percentage of mortgage lending discrimination complaints. In fact, lending complaints increased by 66% from over the previous year. So yes, it is alive and well, and we must address it.
Mr. Morreale?
And I would add that in 2022, the effect of long-term systemic discrimination remains real in this country. It's seen in the consistent disparities in mortgage denial rates. It's seen in the disparity in home ownership. It's seen in the disparity of the lack of access to both loan and equity capital by Black businesses. It's seen in the relative size of Black businesses versus white businesses in this country. So the responsibility is to deal with discrimination as it exists today, but also an important responsibility to understand the historic systemic discrimination which causes the American economy to underperform because human capital, a great talent, is being limited and restricted because of discrimination in the financial services industry.
Thank you. Ms. Nelson, same question. Discrimination exists in financial services?
Absolutely, and it exists in a number of different forms. Many like to focus on discriminatory motive, which is very clear and explicit, and we've given a number of examples of that. But it can also exist when there are race-neutral policies that result in racial disparities that are evident and avoidable. Discrimination occurs when disadvantage is imposed as a result of your race. That can happen because there is an explicit intention to do so, or it can happen as a result of policies that either mask a nefarious intention or that perpetuate and exacerbate existing racism in our society. So it exists in all of those forms, and it exists, unfortunately, in profound ways in our financial system. We've spoken about disparities in home ownership, wealth. We've spoken about discrimination in the ways in which Black homes and homes of color are appraised. And my colleague at the end of the table has done amazing research on that front. But there are many other dimensions to this, including the PPP loans that Black businesses received in comparison to white businesses. There was a significant gap in what the government doled out to businesses owned by different groups of people in this country.
Thank you, Ms. Nelson. The CFPB recently made updates to its unfair, deceptive, and abusive acts and practices exam manual to better protect people and communities from illegal discrimination. Again, starting with you, Ms. Rice, and Mr. Morial and Ms. Nelson. Do you think the CFPB update making clear that discrimination is covered by UDAP was an important move for the CFPB to make?
Yes, I do. Discrimination can be both, actions can be both unfair and they can be discriminatory. And I'll lift up an example of a case that the CFPB brought under UDAP in conjunction with the Navajo Nation to stop an illegal tax refund scheme that steered borrowers of color, including consumers of color, including many members of the Navajo Nation, to a very high-cost, exploitative tax refund anticipation loan product. The CFPB used its authority under UDAP to bring this action, which again was both discriminatory and unfair. So the clarifications that the CFPB recently made, they are not a new approach, they're not an overreach, they're a clarification of the policies and standards that the CFPB has used all along. And I think it's critically important for regulatory agencies to provide additional clarity so that all stakeholders can understand how those regulatory agencies are interpreting the law. That case was brought in 2015.
Let me make two points. Number one, all the talk about regulatory certainty, the CFPB's guidance is designed to create, for those who are regulated, more certainty as to how this statute will be interpreted. But it is troubling, and it is an act of betrayal for some who, in the wake of the murder of George Floyd, trumpeted their commitment to a new day for racial equity, to then turn around and go through the back door and challenge this guidance in court. And we are going to continue to call out the notion that once you play uptown and you pray downtown, Senator Brown, where on one hand you say we are going to do things differently, but then you turn around and file a lawsuit against something which is designed to create more regulatory uncertainty. So I agree with Ms. Rice, but I want to add that perspective because I think it's very important that you can't on one hand say we want regulatory certainty, and then on the other hand, when regulatory certainty is ordained in a guidance, you walk to the courthouse and you challenge it after you have made so many public statements about your commitment to racial justice. So it's important for this committee to understand that perspective.
Thank you, Ms. Moore. Ms. Nelson.
Yes, so to be clear, the CFPB has the authority to regulate discriminatory conduct as an unfair practice under Dodd-Frank. And I know this committee knows that in order to constitute an unfair practice under Dodd-Frank, a practice has to satisfy three prongs. One is that it's likely to cause substantial injury to customers. Two, that that injury is not reasonably avoidable. And three, that that injury is not outweighed by countervailing benefits to consumers or competition. And in the words of then FTC Commissioner Rohit Chopra, discriminatory practices from many financial institutions are 3 for 3 when you consider each of those considerations. That discrimination must be addressed by regulatory agencies. That is their charge. It is not beyond the scope of their authority to do so. And we hope that there will be additional reinforcement to allow this agency to do its work and to fill the gaps that I identified in my testimony in our current federal statutes that are important, but do not take us all the way in protecting against racial discrimination in financial services.
Thank you, Senator Toomey.
Thank you, Mr. Chairman. Mr. Westhill, you made what I thought was an important point, the gist of which was we shouldn't underestimate discrimination where it exists, and we should call it out and fight it. But it's also important not to find discrimination where it does not exist. I'm wondering, so you and Congressman Donalds, both black men who grew up in the South, I wonder if either or both of you would care to briefly address, I mean, I'm sure you've seen and experienced discrimination in your lifetimes. Could you just reflect on how important it is that we get this right? In other words, see discrimination where it exists and fight it and not choose to find it where it doesn't exist.
Yeah, I'm happy to respond to that. Thank you very much for the question, Senator. I think it's terribly disempowering if we tell young minority kids in this country that there's discrimination everywhere, there's racism everywhere, there's bias everywhere, that it's institutionalized, that you're going to see it at every turn. That's terribly disempowering. Why would you want to really try your best and succeed and achieve when you know you can't do it anyway, when you're being told that over and over again? I think that overestimating bias or racism or discrimination is terribly disempowering and is not helpful. What we really should be doing is putting our finger on exactly what that is and being careful about the way we speak. I think the dictionary definition of discrimination is something very akin to intentional prejudicial treatment. Disparate impact is not that. That is a disparate, that is a gap in outcomes. Okay.
Congressman?
I agree with what the gentleman said. The only thing I would really add to it, Senator, is if you're going to get into issues associated with what the outcomes are, let's take home ownership, for example. Well, there's a lot of criteria that goes along with it. Number one, what's your credit score? Because if you have a 700 credit score, it's much easier to qualify for a home loan versus if you have a 600 credit score. Number two, what's the value of the home you're trying to buy? Number three, do you have a down payment for the home you're trying to buy? If you take a look at home prices throughout the United States, what's happening is they actually are rising in part because the material to build a home is rising. So if your income level is X, but the cost of the home continues to rise, that's going to have a negative impact overall on your ability to acquire the home. If you want to get into the situation of looking at money you want to borrow for a small business, and one of the things that we are talking about is, are there impacts on disadvantaged communities, minority communities, because of the way banking is structured in the United States right now? I would say, yeah. But that fault lies here on Capitol Hill. Because like I said in my testimony, since the passage of Dodd-Frank, community banking in the United States has been eviscerated. So if you're trying to get a business loan, typically how that works is you have a relationship with the lender in the local community bank. If community banks are gone, what's your relationship? Right. And the Wells Fargo checking account is not a banking relationship. That's a place where you deposit your money. As a former Wells employee, I can say that.
Yeah, and you're absolutely right. Empirically, there's no disputing that after Dodd-Frank, the launching of new community banks in America simply stopped. It just ended. Mr. Westhill, you in your testimony you pointed out that disparate impact theory is actually in tension with the constitutional guarantee of equal protection because it promotes race-conscious decision-making. Could you elaborate on that at all?
Sure. So basically what you're doing, if you're telling regulated entities that they have to get the outcome right, there's going to be a look right? At the skin color, at the ethnicity, at the gender, what have you, of the individuals that are asking for a loan or whatever the situation is, because they're trying to avoid liability. That actually encourages racial discrimination. It doesn't do away with racial discrimination. Think about that hiring manager, for example, who at a large bank needs to get his numbers right in terms of the diversity initiatives that the bank has launched. We've heard about something like this fairly recently. And so they're looking at the individuals that they're interviewing more closely for their skin color. And it doesn't always mean that those individuals are getting the job or getting the loan either.
Right, and I wonder if the Congressman or Mr. Westhill would comment on this. So we know that the CFPB used flawed data and methodology in the past. Now they're claiming to have more authority to expand the use of disparate impact. What's the net effect that if they get their way, if the CFPB gets its way, what's the net effect on the cost and the availability of credit and financial services in minority communities, in your view?
Oh, I'm gonna tell you right now, the cost is gonna skyrocket, because what you're gonna do is you're gonna have to bring in, frankly, more middle managers into every banking institution to deal with the new loopholes that CFPB is going to create. Everybody's gonna have to double check and triple check boxes. All that does is add more costs to delivering credit into these communities, or any community for that matter in the United States. And at the end of the day, as somebody who underwrote credit, so I did this as a living, everything that you lend has a cost to the bank. And if the costs are prohibitively more expensive because of the unintended consequences of a regulatory burden from the CFPB, which, by the way, is still unconstitutional in my opinion, then what will happen is the cost will be borne by the consumer in higher credit costs. And if you're talking about people in the United States who are at the lower end of the socioeconomic spectrum, the burden will fall on them more than anybody else. And you might actually dry up lending opportunities in the process as well.
Yeah, I was just going to make that point. I think not only are costs going to skyrocket, as Congressman Donalds suggested, it may be the case that services are just not provided at all. It's too cost prohibitive, or the liability is too great to even provide the services, and it's going to fall disproportionately on minorities, senior citizens, immigrants, individuals who can't afford to have that sort of scenario play out.
Thank you very much.
Thank you. The chair has had to go to another hearing, so I'm going to ask my questions, and then Senator Reed will follow on. First of all, welcome to all of you, particularly my constituent, Mr. Morial, who we're proud to claim as a New Jerseyan, so it's good to see you. I just want to make one comment, and that is that the system as it is isn't working for us. So if we think the system as it is working just fine, then something is wrong. I'm proud to be a co-sponsor of Chairman Brown's Fair Access to Financial Services Act. But in my view, in order to root out discrimination and promote equitable access in the financial system, we need to start at the top with our regulators. Right now, there is a staggering lack of diversity in leadership positions at the institutions that set and enforce the rules of the financial system. As a result, Black and Latino communities lack representation at the table when these critical decisions are being made. So I'd like to ask Ms. Rice, Ms. Nelson, what are the consequences of underrepresentation of minority voices among financial regulators?
Sure, I'm happy to start off there, Senator Menendez, and thank you for the question. So I think it's critical because bringing diverse representation to the table when rules are being set increases the likelihood of creating a more accurate rule. It also increases the likelihood of ensuring that we have the right data brought to bear. I mean, that is one of the reasons that we had the foreclosure and financial crisis in 2008, because we had the wrong data, right? We were being informed by the wrong information in the lead up to the crisis. But it also makes sure that the rules that we craft are accurate, and we're considering how those rules are going to impact all market segments. So it's extremely important.
Yes, I would agree. And I think this panel demonstrates that when we're looking for diversity, it is important that we have a diversity of thought, a diversity of experiences, people who understand the plight of communities that suffer the racial disparities that we've outlined today, and people who have not traditionally had access to credit, access to equal financial services, those who have experienced direct discrimination based on motive or based on impact. Because those voices, as Ms. Rice has said, will impact how we think about policy and how we create policy that can remedy those harms and not perpetuate them.
Well, I can tell you from my own experience of 30 years in Congress between the House and the Senate, if I and others like me were not here, issues that are critically important to our communities would just not be either brought up or pressed. And that doesn't mean that others aren't well-intentioned, but they're not doing it. They're not putting political capital on the table to make it happen. One of my concerns has been the Federal Reserve. It has a well-documented diversity problem in its 108-year history. The Federal Reserve has never had, for example, a Hispanic regional bank president. And this is an institution that's making some of the most important decisions in our economy. Let me ask you, the FDIC found that nearly 6 million households in the country are unbanked. These families have no access to checking accounts, debit cards, credit cards. Instead, they use cash for day-to-day purchases. And another 14% of Americans are underbanked, which means they rely on money orders and other alternative financial services to complete transactions. Mr. Morial, in your work, have you found that the unbanked and underbanked populations are disproportionately people of color?
They're disproportionately people of color, and the reality is that in communities that are banking deserts, payday lenders, check cashers, informal lenders proliferate, and they rent money at usurious interest rates. They rent money on abusive terms, and they proliferate. And if you go into any community across America, you can go into Newark, or you can go into Jersey City, or you can go into Patterson in New Jersey, you can go into Providence, you can go into Philadelphia, Pittsburgh, Scranton, or Harrisburg, and you go in the black and brown communities, you're going to see an active effort to use television advertising, radio advertising, street teams to market these types of services in these communities. So it's a double-edged sword. The banks are not there, but the predators are there, and it has a negative impact on black and brown and underserved, and I might even add, such is the case in many rural communities, such is the case in many communities that happen to also be white or Asian. Underserved, underbanked communities are a haven, a breeding ground for predatory financial practices.
One final question, and then Senator Warren is next. According to the New York Times, Wells Fargo conducted fake interviews with women and minority candidates for positions that had already been filled. The bank reportedly undertook these fake interviews to artificially boost diversity statistics in an attempt to satisfy an internal goal to interview at least one woman and one person of color for each position. That information that uncovered by the New York Times is not only highly offensive, it suggests to me of a systemic bias and discrimination at the bank, but it raises questions of a broader pattern. Ms. Nelson, if a bank is bringing in candidates of color for positions they already fill just to create an illusion of diverse hiring practices, can we say that bank is making a good faith effort to promote diversity, equity, and inclusion?
No, we cannot. We cannot. I think it's quite clear that that's a...
And that speaks to the culture, right?
Absolutely, and it speaks to the notion that there's already an idea as to who is worthy of working at a bank and who is pre-selected as a preferential candidate in that workplace, and that candidates of color have already been ruled out of the equation.
Thank you very much. So, Senator Warren.
Thank you, Mr. Chairman. So the 2008 financial crisis was triggered by big banks and other financial institutions targeting communities of color with predatory mortgage loans. So to ensure that that never happens again, Congress made it illegal under the Dodd-Frank Act for any company offering consumer financial products to engage in, and I'm going to read the language, unfair, deceptive, or abusive acts or practices, or UDAPs, as they are known with the acronym. Congress also created the Consumer Financial Protection Bureau and put it in charge of enforcing these laws. Under Dodd-Frank, a bank commits an unfair practice if three conditions have been met. First, that the practice in question would likely cause substantial injury to the consumer. Second, consumers couldn't reasonably avoid that injury. And third, the injury is not outweighed by other benefits to consumers or competition. So I want to talk through what that unfairness standard means in practice. Ms. Nelson, you are an expert on civil rights law, so let me run through an example with you. Say somebody walks into a bank wearing a cross around their neck, and the bank teller takes one look at them, refuses to help, and tells them to leave, maybe even calls the police to kick them out. Ms. Nelson, do you think that situation would cause the consumer substantial injury?
Absolutely.
First element. Okay. Do you think the consumer could reasonably have avoided the injury?
I don't see any way they could.
Okay. And do you think there might be some public or economic benefit to the bank teller for doing what they did that should outweigh? Okay, good. All right, so we've gone through the test that Congress wrote into Dodd-Frank to define unfair practices. Ms. Nelson, would you conclude that this bank, if it met these three tests, may have violated Dodd-Frank by unfairly discriminating against a customer on the basis of their religion, and that regulators should probably take a closer look at this bank?
Yes, they should.
Okay, good. And if the bank can't do this because of someone's religion, do you think the bank should be able to do this because of someone's race?
Absolutely not.
All right, I agree. And that is why I am very glad that the CFPB is cracking down on discriminatory and other potentially unfair practices under the law when it updated its examination procedures earlier this year. This ensures that the CFPB examiners are doing what Congress told them to do: root out unfair practices against consumers, whether the unfairness is because of their religion, their race, or their sex. And yet, the United States Chamber of Commerce and other lobbyists for big banks have come out in full force to claim that CFPB examiners investigating potentially unfair discriminatory practice amounts to, in their words, abuse. Now, listen to that again. The bankers claim that the CFPB is engaging in abuse of the big banks if it stops those banks from discriminating against customers based solely on race. Wow. So over and over, the banks have been caught red-handed discriminating against customers. My colleagues were just talking about it. In 2011, Bank of America agreed to pay $335 million for charging Black and Latino customers higher rates on mortgages. In 2012, JP Morgan Chase got caught doing the same thing and paid $55 million in penalties. In 2017, Wells Fargo got caught doing the same thing and agreed to pay $175 million. Mr. Morial, your organization has been on the front lines protecting consumers against unfair practices. Can you tell us a little about the impact these practices have on consumers?
Well, thank you very much, Senator Warren, and thank you for your leadership. Settlements are never effective to help people recover the wealth that they've been stripped of. And settlements alone do not form, I think, an effective deterrent to future discrimination and a continuation of the practices which led to the lawsuits. You and I both know, and this committee knows, that when the financial crisis took place, the taxpayers of this nation rode in on their stallion and rescued these banks because of the thought that if they did become destabilized and went on, the broader economic impact would be severe. So at that time, the idea of the CFPB is that there needed to be a stronger methodology and enforcement arm to prevent the reoccurrence of the kinds of practices that brought us to fall of 2008, which was a tragic moment for this nation. I testified before this very banking committee in 2010 on that crisis and on the need for CFPB and on the fact that a false narrative had been created by the financial services industry that it was lending to black and brown people that caused the crisis. And in this committee, with statistics and charts and graphs, that theory, that narrative was debunked. And so once again, we have to push back against any notion that CFPB somehow is going to negatively impact the availability and access to capital for black and brown communities. Such an argument is preposterous and disrespectful to the long history of this nation in trying to overcome systemic discrimination. So CFPB is an essential, very important agency. And for those that don't support it, give me something better. But having nothing is not an option.
All right. Thank you very much. I appreciate your longtime work in this, and I appreciate your strong voice in this. You know, the idea that the banks will continue to argue quite openly that they want to protect their ability to discriminate against people based on race is truly outrageous. And I applaud the CFPB for saying, not on their watch, not going to happen.
Thank you.
Thank you. And I now recognize Senator Warner. Sorry about that.
Sorry, Mr. Chairman, I was It's great to see the panel. Mr. Chairman, are you open at all to a brief second round of questions at any point?
Perhaps, but you haven't done your first round.
No, I understand that, but I just
Well, let me say it this way. If your first round is so outstanding that you deserve a second round,
I
you're
just
more likely to.
Wait a minute, is that the test?
Senator Warren, Senator Warner, it's the test.
I'm just saying.
We aren't dismissing it. I don't know how the hearing's going to go.
No, the reason is this, and there is a decade-long ferocious competition that has been going on between Virginia and Maryland, shocking as that may be, over the location of the FBI headquarters. And certain very distinguished members of this panel have weighed in on that issue. And many of the members of this panel I'm very familiar with. And my sense is that issue may be raised by my good friend, the senator from Maryland. The only reason I would like to come back, if he chooses to raise that, is that, I think the Biden administration has been very good at charging the GSA and the FBI to come up with a set of criteria on what is in the best interest of the FBI, its workforce, and for the first time ever, on a major selection of a federal building, has put in as one of the criteria equity, which is all about fairness and all about something I know you care about, I know Senator Warren cares about, I care about, members on both sides of the panel care about. I have tried not to kind of elevate this into the press because Maryland and Virginia's enormous frustration with the last administration was that after years of work starting under the Obama administration on having a fair process, and we were down to the final straws, and we're going to duke it out between the two jurisdictions, Maryland delegation is suddenly starting to say, well, you know what? If we don't like the criteria because it actually includes what the FBI might need themselves, and if we don't get what we want, we're going to go to the White House and change the criteria. The exact critique we made of the Trump administration at the 11th hour coming in and changing the criteria and taking that process totally aside because of suspicion many of us had that they didn't want the FBI headquarters moved out of D.C. because Lord knows you might have a hotel that would then compete with the Trump Hotel. And I am all for equity being part of the consideration in this decision. And I just was going, if my friend, the senator from Maryland, was going to raise this issue, I was going to make the point that, one, I think the Biden administration has laid out fair criteria, and I was going to make the point that the Springfield location is one that is 60% people of color, 40% foreign-born, hits a whole host of criteria on the equity basis that are important. I mean, listen, PG County, there are 2 sites, and they are great sites. They have strong equity issues to make as well. And I was going to, if that issue was raised, I was going to make an appeal, particularly as somebody who I've known as well as the national president of the Urban League, that I would urge you, because I thought we were going to try to play by the rules that the administration had laid out. I was going to try to make the plaintiff appeal to he and others on this panel that let us make the presentation on equity issues about the site that Virginia puts forward.
Now,
he may not raise that, and
I'll just say, and I know the hearing isn't on this, my first choice was for the headquarters to remain in Washington, D.C. Honestly, my second choice, move it to New Orleans. My third choice,
touche.
my third choice was to move it to Newark, which is near where I live now.
Yes, sir.
And then my fourth choice was Maryland, and now my fifth choice is Virginia.
and all I'm asking, President Morial, is that, and again, this is all's fair in this process. Let me be clear. When my friend, the senator from Maryland, comes back in, this is a critically important decision for the people that work at the FBI, for fairness for the whole region, and the equity debate is an
My
important.
team and I are open to listen.
And all I'm trying to say is
love to
that
sit
we
down.
would love to have the opportunity to make the same kind of presentation to you about the equity issues. I have been concerned when the Maryland delegation has said, if we don't get the outcome, we're going to go to the White House and try to change things, which seems exactly our critique of the last administration's techniques. But all I would ask is that we have that opportunity. I'm happy, and I do actually have questions on this subject, but I don't want to, if somebody's waiting from the outside to come back in and
Senator Smith is next, so
Okay.
she's waiting.
She is waiting?
She's waiting, yes.
Okay, well, I will stop my questions. I appreciate the chairman's discretion, but I would like to be able to come back.
I will try to include you.
Yes,
of course.
yes, sir.
Okay,
Thank you.
got it.
Thank
Thank
you,
you, Senator. Thank you, Senator Warner. Senator Smith is recognized from her office from Minnesota.
Thank you, Chair Brown. And thank you, Senator Warner, for that excellent demonstration about how to seize the opportunity wherever you find it. I appreciated that. I want to talk about the issue of discrimination in mortgage lending. The Minneapolis Fed published a paper earlier this year on this topic, and it laid out, we know that in the Twin Cities area, people of color are up to 3 times more likely to be denied a conventional 30-year mortgage than white applicants. The Minneapolis Fed's findings aren't surprising. The pervasiveness of this issue, though, is really jarring. Now, of course, we know that lenders consider multiple factors when reviewing mortgage applications, many of which are race neutral, at least on their face. However, this study specifically focused on low-risk borrowers, and even when controlling for differences in income or credit scores, and even where a home is located, Black and Latino and Asian borrowers continue to be denied at higher rates. Based on the findings of this Minneapolis Fed report. Ms. Rice, can you talk to us about what the consequences are of an economic system that so blatantly excludes families of color from accessing home ownership? And what should we be doing here in Congress to address this specifically?
Yes, thank you so much for the question, and you're absolutely right. Study after study has found disparities in access to credit for borrowers of color. For example, Berkeley researchers have found that Black and Latino consumers who have the same financial profile and the same credit scores as their white comparative borrowers are being charged higher rates when they do access mortgage credit by risk-based pricing systems. And these are algorithmic models that are supposed to take in a number of considerations and factors when pricing risk. But they are pricing borrowers of color at a level that is higher than their commensurate level of risk because of multiple factors that are included in those black box models. Black and Latino consumers are paying $450 million every single year, because they're being charged higher rates than they are supposed to be charged. And there are many, many costs of discrimination in our marketplace. And I'm so glad you asked this question, because I oftentimes like to quote and cite former Federal Reserve Board of Governors Chairman Alan Greenspan, who talked precisely about the cost of discrimination. And he said, and I'm paraphrasing, that discrimination, this is intentional discrimination and unintentional discrimination, erects barriers to the free flow of capital and labor to their most profitable use. He also explained that bias in our markets distorts outputs, creating higher costs of goods. And I must say this, discrimination increases the cost of goods. Eliminating discrimination decreases the cost of goods. It also decreases our national wealth. He talks about how removing non-economic distortions like discrimination increases yields and output, expands our economy, and generates higher returns to both people and physical capital. Discrimination, we know, is one of the major drivers of the racial wealth gap. So let me just cite this. Not only, so when you look at families, when you just look at families, households with children, Black households with children have 1 penny of wealth for every dollar of wealth held by white families. That's a penny on the dollar. Latino families have 8 cents of wealth for every dollar. That's a huge racial wealth gap. And it is causing all kinds of downstream challenges and inequities that we have to face. And we've said over and over again that if we eliminate discrimination, it benefits everyone. It's a win-win. And this is something that we really seriously must address. There are loopholes in the laws, and we have to close those loopholes.
Thank you very much for that answer. And I think that this is near and dear to my work, because the Minneapolis metro area has the largest Black-white home ownership gap in the entire country. And it is getting worse. It's not getting better. According to the Minneapolis Fed, the Black home ownership rate peaked in 1950 in Minneapolis. So this is not a historic problem that, meaning it's not a problem that exists in history. It exists in the current world when the impacts of that discrimination have broad-reaching, are broad-reaching. So thank you, Mr. Chair.
Smith, Senator Van Hollen has been introduced marvelously by his colleague in the next state. So Senator Van Hollen of Maryland.
Thank you, Mr. Chairman. Well, I said to Senator Warner, seniority has its privileges. Since he raised the issue of the siting of the FBI building, I feel compelled, Mr. Chairman, to focus on that issue. And I will say, if my colleague wants additional time afterwards, so will I. So I'm going to start with you, Mr. Boreal, because we are talking about a different kind of discrimination. We're talking about discrimination that has an impact on economic opportunity and on the racial income and wealth gap in the Washington, D.C. area. And that has to do with the citing of federal agencies. And if you look at the history of citing of federal agencies in the Washington, D.C. area, there is no doubt that the majority Black Prince George's County has gotten the short end of the stick. While Prince George's County has about 20% of the region's workforce, it hosts less than 5% of the region's office space. You have written a letter, you and other civil rights leaders have written a letter to the president and to the head of GSA on exactly this issue. Can you talk about your concerns and how this does play into the discussion about income and wealth equality?
When President Biden signed his executive order on racial equity, one element of its implementation was its impact on decision-making in the siting of federal facilities, not only in the DMV, but all across the nation, where courthouses, where federal buildings are located, to ensure that communities of color, urban communities, communities where Black and brown people live would get their fair share of those investments. So in this instance, the leadership of Prince George's County and many leaders in Maryland, including yourself, reached out to many of us to suggest that Prince George's County had not been treated fairly in this decision making historically, and that while I said earlier before you came into the room that my first choice was Washington, D.C., my second choice was New Orleans, my third choice was Newark, that it was okay if my fourth choice was Maryland and Prince George's County, because Prince George's County for the DMV represents something interesting. When I attended law school here at Georgetown in the 1980s, Prince George's County was a predominantly white, suburban and rural community. It has since become the largest predominantly Black county anywhere in the United States. And notwithstanding the fact that there are many rising middle-class families in Prince George's County, there is still a high level of poverty, a high level of many, many challenges and issues that affect communities of color. So it seemed to make sense that in this instance, since the FBI insisted that it could no longer operate effectively solely in downtown Washington, D.C., that Prince George's County made a good sense place to ensure that a Black community, a Black jurisdiction, would have the opportunity to host and be the home of a facility that will employ literally thousands of people. But then the second and third impact of it in terms of services and retail and hotels is almost immeasurable over a period or an arc of probably 10, 15, 20, 25, 30 years. So it was, Senator Warner, no slight to Virginia at all. It was this sort of analysis, but I also think that I want to give some due credit, because we're in a public hearing, to the fact that the community leadership and the local elected officials in Maryland got very active in reaching out and encouraging us to think about this and to support this instance. This is not something we would normally involve ourselves in, but because of the president's commitment to racial equity, supported by all of you, I think, here in this room, we think it's important that the administration be held accountable to live up to that when these decisions take place. So that's the background here. And again, no slight to the great state of Virginia, but sometimes when you face these sorts of things, in order to correct the imbalance, you've got to do things differently. And I think here, that's why Maryland seemed to make a good choice. But again, Senator Warner asked us to listen to what the people of Virginia or the community leaders of Virginia have to say. And while I've already written a letter, I'm certainly willing to do that along with my staff and I think the other civil rights leaders, because it's a fair thing to do. And maybe there's some perspectives on Northern Virginia that we're not aware of. But we're sticking with Maryland for now, since New Orleans and Washington and Newark aren't going to work.
Oriel, thank you. Well, no, I would just say to my colleague from Virginia, if he thinks that Virginia has some equities in this issue when it comes to the diversity of the community and the fact that Fairfax County has been overlooked, which it clearly has not, then he will agree with me that when the FBI and GSA grade the issue of equity, that they will raise it from the low 15% that it is to a higher amount that would reflect the president and the Biden administration's commitment to equity. And the president said, and I quote, when he issued that executive order, "We need to make the issue of racial equity not just an issue for any one department of government. It has to be the business of the whole government." And I would submit that the GSA and the FBI clearly haven't gotten the message, given the low weight they've given to this factor. And again, if my friend Senator Warner wants to join me in urging the administration to raise the weight of that factor, we welcome that.
Thank you, Senator Van Hollen. We really weren't planning a second round, and this has been a rather unusual twist in our committee process. But Senator Warren, I would appreciate if you actually would spend less time debating him on this and go into your round of questioning. Then Senator Toomey wants to ask a couple questions, and I will close. But go ahead.
Thank you, Mr. Chairman. I appreciate the courtesy, and I appreciate President Morale. We've worked together on a lot of years, and I look forward to presenting the facts like 60% of the population in Springfield is people of color, 50% speak a language other than English at home. And we actually, in our state presentation to the GSA and FBI, included these equity issues. And I just don't think we ought to be second-guessing the process. But I think I'll start with you, make sure the whole panel gets a chance to weigh in. One of the things that the chair and Senator Van Hollen and I completely agree is a huge part of discrimination in the banking system comes from lack of access to capital. And our historic institutions have not done a very good job. We've talked many times over the complete destruction of the vast majority of MDIs in this country after the Great Recession in 2008 and 2009. One of the areas that I firmly believe is a growth possibility is to reinvigorate MDIs, also to take the fairly small niche of the financial sector, banking sector, CDFIs, community development and financial institutions, which by definition have to lend 60% into low and moderate income communities and do more. This is one of the areas, in kind of a strange bedfellows, we found common cause with the former Secretary of Treasury, Mr. Mnuchin, but we were able to secure a record $12 billion, $3 billion in grants, $9 billion in Tier 1 equity into these institutions. And I think that and the next round on CRA is going to help push more capital into these institutions so we can start. And Ms. Rice and I, we've had some debates over how we get more black and brown home ownership and down payment assistance versus, I believe still there's a great opportunity to first-generation, first-time home buyers, disproportionately people of color, give them a chance to acquire equity, make a 30-year mortgage, give them a 20-year rate, double their acquisition equity over a 10-year period. But my question for everybody on the panel is, and again, this is an area where I think the chair has weighed in a number of times as well. We know the Fed has to try to get inflation under control. My concern is, in their zealousness to get inflation under control, you could end up driving us into a recession. And the very institutions that we've just come to help may be the first in line, because while we've seen under COVID, 400,000 black businesses lost. The good news post-COVID is the fastest growing rate of new businesses are black women.
Yes.
But those businesses are going to get squeezed the most in this next phase. So I've been talking about, should there be maybe not looking at mark-to-market on CDFIs, maybe a little regulatory forbearance. We need to put guardrails in place to make sure that some of the progress coming out of COVID for entrepreneurs as well as CDFIs and MDIs don't get washed away, God forbid, if we fall into a recession. So I start with Mr. Morial, and I'm done with questions, but I'd love to hear from the whole panel. Thank you, Mr. Chairman.
Absolutely on point when you say that strengthening MDIs, minority depository institutions, basically black, Asian, and Latino-owned banks, could make a difference because their propensity to lend to black potential homeowners, to black businesses and black consumers is certainly greater than mainstream banks. Combined, these banks probably have less than $3 billion in assets. They're relatively small, even on a combined basis. So the growth opportunity is significant. What they need is equity capital, because they can plus that up and lend it at a greater rate. And so to the extent that you and this committee can find ways, and I would say, Senator Toomey, that this issue of strengthening black businesses in the 70s, the 80s, and the 90s, and even into the early 2000s in the Bush years, was an area of bipartisan consensus. There was a tremendous effort, and this was one of these things that never brought the same amount of partisan friction. So I would agree with that, and I think we need to think about that. As far as CDFIs are concerned, one way to assist CDFIs would be to figure out a better way to fund the loan loss reserve component of their capital structure. That tends to be very difficult to raise the money to sustain it, because that's not money you're going to lend. That's money you raise and you hold to offset non-performing loans. So CDFIs, but I would also offer this. Many CDFIs are far more focused on real estate transactions, which are less risky because they take a small position in a large project, versus those like ours, the National Urban League's new Urban Empowerment Fund, which we just relaunched, I should say, which is our CDFI, which is exclusively focused, primarily focused on lending to black-owned businesses. So these are two areas I think we should double down, and I think you're right that the impact of an overcorrection by the Fed in raising interest rates too fast and too soon could be devastating on some of the progress that's now being made in the comeback of black-owned businesses.
Thank you, Mayor. I'm going to go to Senator Van Hollen for his second round, and then to Senator Toomey, and then I'll close.
Thank you, Mr. Chairman. I just would like to put into the record a couple of documents related to the earlier discussion Senator Warner and I had in the FBI. It's the letter that Mr. Morial and his colleagues sent. It's a op-ed piece in the Washington Post by Cortland Midloy yesterday, and an op-ed piece by the county executive of Prince George's County that lay out very clearly the income and wealth gaps that have been created in part by the unfair citing of federal agencies in places outside of Prince George's County, Maryland. But on an area that Senator Warner and I agree on, CDFIs. I chair the Appropriations Subcommittee that funds the Treasury Department CDFI accounts, and we have worked to increase those accounts every year, including, we hope, this year as part of the process. And it was great to work with Senator Warner and others who really pushed hard about a year and a half ago, a little more now, to get that new capital fund and the emergency funds. And I really do think they're a critical part of our infrastructure for getting more capital to lower income communities across the country. And I want to talk also about the issue of banking deserts. Baltimore City has now in many places become one of the worst banking deserts in the country in terms of lack of physical banking locations. And that, of course, both in the city but also other places around the country, means that more people have to go rely on other sources of borrowing, including more and more online financing, some of which provide important protections, but many do not. Many are sort of predatory engines where if you don't read the fine print, you get totally overwhelmed with fees and unfair interest rates. This came up yesterday in a discussion, or the day before in a discussion here in the Banking and Housing Committee with the FDIC hearing and confirmation hearing for Marty Gruenberg, for example, FDIC. We're pushing hard for the CRA. I think the CRA will help address some of the changes that have taken place over time that undermined the purposes and intent of the CRA. But the reality is, if you look today, fintech loans account for 57% of the unsecured personal loans. Mm-hmm. They're not covered by the FDIC. They're not covered by CRA. And so one overall question is how do we address that issue? But if you could, Ms. Nelson, speak a little bit about to the impact of the trend we're seeing where you have bank branch closures, so there's no physical presence of the bank. That means more people go online to get their loans, and a lot of these online systems do take advantage of people. Could you just talk about that trend and what we can do about it?
Absolutely. So fintech does provide another option for some persons who are seeking lending, but it is not a remedy to what we've described here today. Fintech also can perpetuate discrimination, and there are a number of criterion that have been harmful. For example, we have worked with Upstart, which was using the SAT scores of universities as a barometer for whether a particular borrower was creditworthy or not. And as a result, there were Black and Latino borrowers who went to schools, including HBCUs, that did not have the highest ranked SAT scores and wound up paying almost $3,500 a year more over the course of a year loan. So it's those types of online services that are unregulated, that are unsupervised in the way that they should be, that can perpetuate discrimination and create further disparities. I would also say that the Brookings Institution analyzed the rates of bank closures in 6 metropolitan areas, including Baltimore, as you mentioned, and found that census tracts with higher rates of Black residents were more likely to experience bank closures between 2010 and 2021. So this is a real phenomenon and a trend that has not abated. And I will say that if we think about the state of Pennsylvania and we think about the racial wealth gap there, where in places like the Philadelphia metro area, where the Black-white homeownership gap is over 26%, and the Pittsburgh metro area that has a gap of over 41%, bank closures and lack of access to financial institutions can have a real impact that exacerbates these already disturbing numbers.
Senator Van Hollen, I know we're over time, but if I can just interject here, because this is an extremely important point. Banks have always, throughout the entire history of the United States of America, disproportionately closed their branches in communities of color as compared to other communities. That has always been the case. It is still the case today. Banks are closing their branches in predominantly high-income, affluent Black census tracts at a higher rate than they are closing their branches in low-income, non-Black census tracts. So it is definitely a problem that we have to fix. When people are forced to go to payday lenders, fringe lenders, it's important to note those entities primarily do not report positive consumer behavior to the credit repositories, increasing the likelihood that their consumers will remain credit invisible and credit unscorable.
Thank you. Thank you all. Thank you, Mr. Chairman. And my challenge to my colleague, Senator Warner, still stands in terms of increasing the weight given to diversity and equity in the FBI citing. Thank you all.
Thank you, Senator Van Hollen. Senator Toomey will have a couple of more questions. And
Thank you, Mr. Chairman. Let me begin by observing, I served in the House, so I understand the view of most House members with regard to this chamber. And despite that, Congressman Donalds was kind enough to come over here and testify. And to all the witnesses who have been very patient during a discussion that may not have been central to what you thought we were going to be here to talk about, I want to thank you for your patience. I'd like to bring it back to a discussion about an aspect of the CFPB's policy. And what I'm specifically referring to is it strikes me as kind of shocking that the CFPB applies this disparate impact theory to auto lending. Congress demonstrates exactly what it thinks of this by repealing that rule. And then they turn around and say, oh, okay, well, in that case, we'll expand it and we'll apply it in a whole new way. It strikes me as a brazen overreach. And I wonder, to what extent do either of you, if you care to comment on this, think that that kind of action is, I guess, the inevitable result of a construct where Congress has no control over this entity? Congress has no say. They have no reason to care whether what they're doing is completely contrary to the wishes of Congress because they know there's nothing Congress can do about it. We don't control their budget. We don't even indirectly control their budget. We have no say over this. And I'm wondering if either of you think that the unconstitutional design contributes to this kind of overreach. Congressman?
It absolutely does. There's no doubt about it. Because they don't have to come and sit before you gentlemen here in the Senate or us in the House, because they don't have to go through the appropriations process, they largely do what they want. There's some conversations with whoever the president might be at the time, but other than that, they're completely unaccountable. From what I hear over at the CFPB office building, they got the best in town and the greatest pizza oven. Why? Because all they do is just go from company to company to company. They do their investigations, they levy fines, and they keep on moving. To a broader point, if you want to address the core issue, and this is actually to, I think, Senator Warner, Senator Van Hollen's point about access to capital, you don't do it by then leveraging an unaccountable agency to have more of a regulatory burden on the financial institution, because MDIs and CDFIs are not going to solve that problem. The reason why we have banks closing in communities all across the country is because of the regulatory burden that has happened since Dodd-Frank became law in 2010. That is the reason. So if we're going to be serious about this and try to find access to capital issues, it's not by allowing the CFPB to do more. It's actually about reining them in once and for all, and then re-examining the banking regulatory structure here on Capitol Hill that will allow the industry to flourish.
Thanks very much. Mr. Westhill?
I would just say, generally, I am concerned about the insulation that the CFPB has from congressional oversight and authority. It's problematic in a number of different respects, including the insulation that the director has. It's outside a little bit the scope of what we're discussing here and this hearing. But I'll say that I think there's a lot of legitimate criticism, reasonable criticism of the rise of these sorts of federal agencies, that there could potentially be a legitimate fourth branch of government growing out of these agencies, and that's really problematic to our constitutional separation of powers and structure.
Senator, real quick, if I may, the one thing we have to acknowledge is, and I agree with what Senator Menendez said, the system is not working. It's not working, and the reason why it's not working is because of the regulatory burden of we have to stop something from never happening again. What's really happened is the big banks got bigger. They got massively bigger. That's not working for small communities. So Congress has to address that from a meaningful way on a regulatory basis and a statutory basis, not by adding more layers to try to fix a problem Congress created in the first place.
Yep. Thank you very much, Mr. Chairman.
Senator Brown? I think I'm just compelled to offer this perspective. CFPB's director is confirmed by the Senate. It's not an unaccountable agency. The entire apparatus of federal regulatory agencies are designed to be insulated from political interference so that political wins and decisions are not going to impact them. So if you challenge the structure of CFPB, then you've got to run the tables on all of the
Exactly right, Mr. I'm going to cut you off. You're exactly right. Mr. Chopra,
Senator, if I may.
we're not going to have a debate here. You've each spoken well about it. The CFPB director will be here in 2 weeks, I believe.
I would
and
only
we will
add
go
that the
from there.
President of the United States makes that appointment. So if the President's making the appointment, to say that it's insulated from politics is ridiculous. That's my only point.
Thank you for that. Thanks for our witnesses today. Today's hearings made it clear there are not civil rights protections to prevent discrimination in financial services. I urge my colleagues to work with me on the Fair Access to Financial Services Act to help protect against discrimination in banking. We heard testimony and highlighted stories that show when wrongdoing occurs in financial services and the bills come due, too often Black and brown communities suffer the most. Black and brown communities don't trust our financial institutions in large part. They feel they need an alternative. We should not accept risky alternatives such as crypto as a solution to be excluded from traditional financial services because of discrimination. Crypto's not the answer. It's not a civil rights solution. That's why we should work past the Fair Access to Financial Services Act and empower effective agencies like the CFPB. For senators who wish to submit questions for the record, due 1 week from today, Thursday the 8th, To the witnesses, please submit your responses to questions for the record within 45 days from the time you receive them. Thank you again. The hearing's adjourned.